My take basically is that the financial services industry are going through something very similar to what the utility industry went through earlier in this decade. That time around, those of you who were invested in utilities might remember tremendous carnage in that sector. We basically had a period from the 1990s where the industry deregulated pretty quickly. There were a lot of dislocations there. A lot of people made a lot of money, of course, as it went on, but by the end of 2000 we had California in crisis, and then events sort of took off from there. A lot of building of power plants, a lot of debt was mounted up, and really by the end of 2001 we had the collapse of Enron, and then through 2002 a number of other companies also went pretty perilously close to bankruptcy. So by the end of 2002 we had roughly 24 companies either in bankruptcy or were pretty close to it. And that was it proved to be pretty much the bottom. It was the biggest decline since the Depression in the utility industry. The Dow utility average was down close to 60%. But at that point, businesses began to get a little more conservative. They went back to the formula, to the type of business that they'd been doing for over a century, and that is basically regulated businesses. And they got rid of a lot of the riskier stuff that was dragging them down before. They cut debt pretty aggressively, and at the same time you saw regulators really start to appreciate the gravity of the situation. So rather than forcibly trying to open up markets and put the burden on the utilities, you had a number of regulators throughout various states begin to work cooperatively with the companies. So anyway, over the last 5 or 6 years, we've seen all this sort of play itself out. And there were a large number of investigations of companies, particularly activities regarding the power market in California and the problems that happened there. These began to be resolved. They began to settle. We started to see some of these power plants that had been built start to gain some sort of value in the market, because at one time you had a number of these things in the hands of companies and no one could really attach a value. There weren't any buyers for them. You know, they basically began working through these problems, and over the last 5 or 6 years we've seen a tremendous recapitalization of the industry, tremendous strengthening of the industry, so that now, even in the midst of this financial crisis, the utilities as businesses have remained pretty solid. Of course, there have been pressures on all companies as far as getting credit in this market and selling commercial paper and so forth, but the companies have been pretty self-sufficient, and with one notable exception, which is really the exception that proves the rule, Constellation Energy, which had a number of involved in a number of activities that most other companies had dumped over the past 5 or 6 years. Aside from the Constellation Energy example, the group has held up pretty well and continue to function pretty strongly as businesses. So it's a pretty helpful example for the financial services industry. I think a lot of what we're seeing right now is a reaction to some of the problems that have really come to the fore. There's certainly a tremendous emotional wave regarding the financial industry because, of course, banks and credit and so forth affect all companies across the board. So definitely some rockiness ahead. And again, that was the example of the utility industry. We had the bankruptcy of Calpine, for example, which occurred in 2005. So not all the companies cycled out at the same time or were able to make their progress on getting back to basics and sort of reestablishing their core businesses as others were able to. Some of the stronger ones, you know, almost had an immediate recovery. But we're still looking at recovery for some of the others. So again, it's a rocky road to recovery. But again, we're seeing some recognition on all fronts that of what needs to be done, and I think we will see more of that, more strengthening in the coming years. Again, the financial services industry really affects all aspects of the economy, and the lack of availability of credit is definitely hurting businesses, which in turn hurts employment, and which in turn hurts retail sales and home prices and everything else. So there are some things to cycle through, but generally I look for the financial services industry 5 or 6 years from now people to look back and see a similar progression as the utilities were able to achieve over the past 5 or 6 years. Now, what does that mean for investing now? Well, it means we can look forward to more volatility in the days ahead. I think it's definitely the case that market emotion is running very, very hard on the negative side. In fact, I don't remember a market where there really was such palpable panic, where you see investors going in there and just instructing brokers to sell pretty much everything across the board. And it's even applied to the utilities this time around, which we've seen a number of companies sink pretty hard under the weight of a lot of selling. So it's indiscriminate. It continues. It's very much fed by rumors, and it's very much global, because now we've seen banks in Europe, we've seen banks in Asia. Particularly Iceland, I guess, is probably the worst example, where they're basically seizing control of the banking system. But again, these are things that are going to continue to play out over time as the banking system, as the financial system in the U.S. Really matures. And I think what we'll eventually see is, again, like the utilities, something more regulated, something more transparent, something more stable, if you will. That will be a lot more sound going forward. But again, getting to that point is going to be a rocky road. And until we really see some concrete progress, I guess, on that front, this market is going to be inclined to panics. And even some of the safer companies that we study and we know are very solid and very strong, don't have credit pressures, don't have severe economic pressures, and basically are actually benefiting from the drop in some of these raw material prices. Even these types of companies you're going to see some selling, and it just basically comes down to people wanting to get rid of their stocks. Now, how do you respond to that? Well, I think the main thing that investors have to do is just keep a clear head, try to keep an even keel on the situation, and as long as a company, particularly a dividend-paying company, continues to perform adequately as a business, continues to stand up to the stress tests that are behind this bear market, and is able to generate the cash flow, continue to pay the dividends it's paying, it's going to make it. It's going to be negatively affected as long as this market continues in this vein, but it will eventually make it. In the meantime, it's going to continue to pay pretty good dividends. So that's a very strong positive, and it's why we really have to keep focused on the economic numbers. I'm fully convinced we're going to see more companies stumble as we go forward, particularly as we see third quarter earnings coming out, and even more so perhaps the fourth quarter, where a lot of these credit pressures are really going to hit home. But again, as long as our companies are standing up to these tests, and they may not have great earnings comparisons versus the year earlier, but again, as long as their businesses are still pretty healthy, as long as they've got the cash flows covering the dividends, the best play is going to be to stick with them. Now, one question a lot of people have asked me is, where do you put new money? People fortunately had a lot of cash on the sidelines throughout this bear market. Maybe they've been a little more conservative. Maybe they've just taken the cash from the dividends. Maybe they've sold a few things along the way. Maybe sold some of the energy stocks when they got high in the midsummer. So they've got a little cash on the sidelines. And if you're in this group, this is an extraordinary time to be buying. I'm not a big fan of averaging down. I hate basically the idea of buying a stock that's gone down just to average your costs down. I don't think that really does any good for you at all. It just makes you a little more emotionally involved with the stock that in question. But it is a good time, I think, for incremental investing. That means a plan of just investing a little bit at a time in some targeted situations. Now, another reason you want to be incremental here is also because we don't really know how these stress tests are going to affect these companies in the long run. Obviously, the credit crunch has pushed the U.S. economy either into a recession. I think definitely what I would consider to be a recession, but the main point being that there's a lot of pressures on companies and a lot of pressures on company earnings. So you don't want to get too aggressive here. But again, an incremental type of investing going forward, I think, will be extremely helpful. The bottoms of bear markets, when the pessimism is really high, those tend to be your very best times to be buying stocks. So again, this is a way of doing it, but you don't want to bet the farm. You want to do it a little bit at a time. I don't really see a big rush.